Hello everyone. Today I want to talk about what happened last week in the crypto market, more specifically about the token Luna. I believe it was on May 12th, in the span of 36 hours, the token crashed almost 100%. I think in April it was trading around $100+, and then it went to a few cents by the morning of May 13th. So in total, almost $45 billion of market capitalization was wiped out in just a day. And this is not some cryptocurrency, it's one of the top 10. It's a widely followed cryptocurrency, and it happened just in the span of a day, and very, very difficult for most people to even react, let alone make adjustments. So what I heard post this is that there were almost a dozen plus suicides across the globe because of this portfolio loss. Now, I want you to think about this. We are investing, some of my companies also invest in fixed assets, some speculative assets. But as personal investors, as personal traders, we invest to have, primarily, I believe, to have a sense of security, freedom, financial freedom. If the investment or the trade you make isn't giving you that, it doesn't make any sense to do that. I want to pivot a bit from our typical corporate finance talk and move into the world of personal finance. If you are a newbie, if you are new to investing and trading, if you are one of those young investors, I think this advice that I'm sharing is very useful. I wish someone told me this stuff when I was in my 20s. So the last 10-20 years of my experience that I have had in finance broadly and also in personal finance, one of the first things coming out of college is to ensure that you don't have debt. There are two types of debt, bad and good debt, but if you are just a beginner, it's better not to have any debt. That must be the first goal. The second goal, very important, is to have at least 6 months of your expenses saved in a liquid asset. So it could be a bank savings account, could be money market funds, but 6 months of your expenses saved in a very, very liquid asset. Post that depends on where you live. Let's say you are in New York or you are in Mumbai, maybe you're taking the subway and you don't need a car, then you can buy or look to buy a real estate, an apartment or something. But if you are in a place where you need a car, buy a car. Buy a car, preferably fully paid in cash, which means often you might not buy a new car, which has a lot of depreciation, but you might be buying a second-hand car, a used car, where the depreciation, the first 2-3 years, where it is for 50-60% of the value gets depreciated away, is taken care, and you're paying for the real value that will last for another 5-6 years without much depreciation. So after the vehicle purchase, you will have to move to your real estate purchase. So it could be an apartment, it could be something, but ensure you have a real estate in your investment portfolio. So this house or apartment can be bought using a loan. I don't have a problem with it, but personally, I want to pay that loan off as quickly as possible. Most financial advisors, and even if you do the math, it might not make sense to pay off the loan quickly, but you need one house to live. And it gives you a lot of mental peace and security if you pay that loan off quickly. It's tough to put a monetary value to that sense of freedom, right? I think it's valuable, very, very valuable. It makes sense to pay off your mortgage as soon as possible. Post that, if you're really interested in real estate, if you want to be investing there, take a loan and buy an investment property, you can leverage there. If something happens and you lose that property, you still have a place to live. So pay off your first house, the one where you live, and invest in an investment property where you can take a loan. It's a good debt. You can take a loan there and leverage it up. Post the house, then we will have to think about our equity and debt instruments, right? Typically, if you're a young investor, you can go almost 100% equity to begin with, because remember, you already have 6 months of your expenses saved in liquid instruments, right? So you are protected for most part. Then you also have a paid off car and probably a paid off house. So you are relatively stable already. And then you can go in and take that extra risk and put the money in equity. So as you build your equity portfolio, every month you keep investing something, then at a certain point, right, when you have almost 3 years worth of money saved in equity, then you can move to fixed income, debt instruments. So the typical rule of thumb is that you need to save 25 times your expenses for you to have financial freedom. So once you have this 25 times of your expenses saved, you have achieved financial freedom. You have the freedom to do what you want to do. You can retire, you can pursue your hobbies, do what you want. You have enough money coming from dividends, interest, some of these passive ways that you have utmost liberty in terms of finance. This is a simple pathway for you to take to get there. We will cover this again in more detail, and we'll be happy to also take any questions in the comment section below. All the best.